Okay, so today we are going to touch on accounting for purchases. Yes, and we are also going to look at depreciation of fixed assets. So, under accounting for purchases, what we are going to look at is the documents in the purchases cycle, the recording of purchases, recording purchases returns, discounts received, payables, control account. But actually control account will be treated as a separate topic, so I didn't take it as part of this note. So let us look at some of the documents in the purchases cycle. Businesses make purchases from suppliers. Purchases are similar in many respects to sales, except that the business is buying from a supplier rather than selling to a customer. So purchases in its own regard has a debit balance because it is a direct expense. Yes, so it involves the procurement of goods in order to resell them. So it's buying of goods and services for resale purposes. So the following documents might be used in a system designed to account for purchases. So one of the documents is purchases order. So when we mention the document, then we state the purpose for which that document is used for. So a purchases order. It is a document sent by the business to place an order. Goods received note, normally denoted by GRN. It is a document produced when goods are received. It is produced after the goods have been checked against the delivery note and what has actually been received. The GRN is sent to accounts staff who will check that what has been received is what was ordered and that the invoice agrees with what was received. So that is the purpose of the GRN. Now we also look at purchases invoice, as I already stated in our earlier discussion that a purchases invoice is used to record credit purchases. So it's a request for payment from the suppliers for goods delivered. So statement is a document from the supplier to show the amount still owed at a point in time. We also have what we call the purchases daybook. The purchases daybook is one of the book of prime entry. It is used to make an initial record of purchases on credit. The double entry and updating the purchases ledger periodically into bracket daily, weekly, monthly. The total for all transactions is posted to the purchases and other expense accounts, with the other side of the entry posted to the payables control accounts in the general ledger. So we have to note this too. The general ledger records all other accounts which are not recorded in the sales ledger, purchases ledger. We have cash ledger. Cash book is both a ledger and a journal. So all the transactions which are not recorded there are recorded in the general ledger or the nominal ledger. And control account is an account that fall under general ledger. The payables into bracket purchases ledger is used to record purchases invoice from suppliers of other items. So actually the purchases ledger is used to record the accounts of various suppliers or creditors, as well as purchases of goods. For example, the payables ledger is used to record details of invoice for rental cost, telephone expenses and electricity and gas supplies and so on. Detail of these expenses must be posted from the purchases ledger to the relevant account in the general ledger. So General ledger too also keeps record of expenses, expense accounts, sales accounts, purchases accounts are all kept in the general ledger. Discount received account, discount allowed account, they are all kept in the general ledger. To facilitate this, a day book must have analysis column which shows the different types of expenses. Detail of each individual invoice are also posted to the accounts of the individual supplier in the purchases ledger. So now this is the double entry. So when we are recording purchases in the general ledger, we debit purchases account. We also debit it. We debit any expense which have been incurred during that period. So we debit it in the expense account, individual expense account. So if we have rent account, yes, and so forth. Then we credit the payables control account. We credit the payables control account. Yes. Then the payables ledger, which contains the individual, it is supposed to be individual creditors account. Individual creditors account, not customers. Individual creditors account. This is a diagram showing an overview of this system together with the sales and cash system at the end of this chapter. So as we can see there, so we have some petty expenses which have been recorded in the purchases daybook. So now the double entry will be debit purchases, credit payables control accounts. We also debit the expense, credit payables control account, debit sundry expenses and credit payables control accounts. As simple as that. When goods are returned to a supplier, a credit note is received. The purchases returns daybook records the credit note details. So the total purchases returns are posted to the general ledger by 1. Debiting the total trade payables account, crediting the purchases returns account or possibly the purchases account. Then returns to individual suppliers are also debited the suppliers individual account in the payables ledger. So as we can see there in the diagram, so we debit payables account. It is showing a decrease in the balance of the debt that you owe your creditors as a business. Then you credit purchases returns account. So that will be a reflection in the payables ledger. So individual creditors accounts. Say it is rather creditors, not customers. So discount received. Now when we say discount received, they are settlement discounts that a business has been offered by its suppliers and which it takes up. The business pays earlier but pays less. Accounting for discount received. The invoice is recorded in the payables at the full amount when it is received. Discount received can only be recognized when payment is made within a given time frame so that a business becomes entitled to a discount. Discount received from suppliers are recorded in the discount received account. If a business decides to take up the offer of a settlement discount by paying the smaller amount sooner, the double entry for the payment is debit trade payables because the business is receiving a discount. Then credit bank, that is cash paid to supplier. Then you credit discount received account, the discount taken by the business. The entity in the discount received account is a credit. The entry in the discount received account is a credit entry because it is effectively a reduction in an expense So that is it. In the statement of profit or loss, it will be shown either as other income or as a negative expense. Yes. Discount received do not affect the total figure for the purchases in the period or the total cost of the sales. In this respect, they differ from purchases returned, which do reduce total purchases cost. Discount received are accounted for as an addition to profit in the period. They are not accounted for as a deduction from purchases cost. Example, discount received. Adeola has sold goods to Benjamin for 80,000 Ghana cedis. Adeola offers a 3% settlement discount if payment is made within 20 days. Benjamin pays in 19 days. Benjamin will record the transaction as, so it's rather Adeola, right? Yeah, Adeola. So at the date of purchase, we are going to credit trade payables account and debit purchases account, as we earlier know. But when there is this discount being applied, what we are going to do is that we are going to debit trade payables with the whole amount and credit bank with the amount left after the discount, then credit discount received with the actual discount. Okay, so that is the treatment for discount. Discount received and the payables ledger. Discount received are recorded in the individual suppliers account in the payables ledger. Yeah, so in the payables ledger, that's the individual suppliers account, we record the discount received and the corresponding entry, because every double debit entry should have a double corresponding credit entry. So that means if we have the discount received recorded in the payables ledger, which is the individual creditors account, then it means the corresponding credit entry will go to the discount received account under general ledger, as I was saying before. Discount received. Okay, so payables control account. I said I will not be talking about control accounts because it is a separate topic that we will be handling. So that is the format, and the contra entry and those stuffs too. I will not talk about it because they are all under control accounts. So I think I spoke about cash book the other time. I said cash book is both a journal and also a day book. So cash receipts are debited to the cash accounts, and cash payments are also credited towards the cash account. So we will be handling a topic known as bank reconciliation statements, and there is where you adjust your bank statements with the business's cash book. So that is it. Okay, there is also an interesting topic that I want us to look at, that is accounting for value added tax. Accounting for value added tax, which is known as VAT. So let's look at the nature of VAT. VAT is a tax on sale of goods and services. Businesses that are registered for VAT must add VAT at the appropriate rate to the selling price of goods and services they supply. Now, the current VAT rate in Ghana is 15%. The VAT is then collected from customers and handed over to the tax authority. So actually, VAT is a tax on consumption of goods and services. So the incidence and impact of tax is actually not borne by the sellers, but rather it is shifted to the customers. So that is what we have to know. Net and gross amount. The amount which the business wants to be paid for the goods or services it supplies is described as being net of VAT. VAT is added to this to give an amount described as gross of VAT. So there is an illustration. A business operates in a regime where the VAT rate on the goods it supplies is 10%. The relationship between net and gross amount is as follows. So we have the sales before VAT, and then we have the VAT. So actually, um, let's say we are assuming the sales before VAT was 3,000. So a 10% on 3,000 will give us 300. And so it means after the VAT and the price of the good actually is increasing to what? 3,300. So it has increased by the VAT, which is 300. So that means actually the sales that we have is the net. The sales before VAT is the net amount, because net is where you have deducted the VAT. So the net is the gross minus the VAT. So to get your gross, it is net plus the VAT. So that is what has been illustrated there. Characteristics or features of VAT. It is a multi-stage tax. It is a tax on consumption expenditure. The incidence of this tax is borne by final consumers. As I earlier said, it creates an increase in the price of goods and services. As we can see in the illustration, it is an indirect tax. So let us look at the double entry for VAT. VAT on sales is known as output VAT, and VAT on purchases is known as input VAT. Input, we are purchasing, we are buying into the business, so input VAT. And output, we are selling out, so output VAT. So the double entry will be receivables, that's the gross amount, will be debited. Then we will credit the sales, which is the net amount, and also credit VAT control accounts. Then when there is VAT on purchases, which is the input VAT, we debit the purchases at its net amount. We debit VAT control account, and we also so we debit purchases, we debit the VAT control account, and we credit payables instead of receivables. We will rather credit payables. Yes, so that is it. So there's an illustration here. C Limited pays 2,000 plus VAT of 10%. So that means that the gross amount will be 2,200 for an item of inventory and sells it to a customer for 3,000. So the net amount will rather be the gross amount will rather be 3,300. So the necessary accounting entries are as follows. So purchases of an item of inventory. So we are looking at purchases and the sales. So now let's look at VAT on purchases, which is known as the input VAT. So how do we treat it? Let's come back to the treatment. We debit purchases at the net amount. We debit VAT control account. Then we credit what? Payables at the gross amount. So now let's see. We are debiting what? Purchases at the net amount. So purchases at the net amount. Okay, so the net amount there is 2,000. I told you the gross amount is the net plus VAT. So then gross amount there is 2,200, and the net amount is 2,000, and the VAT actually is 200. So the VAT is what you record in the VAT control account. Then the payables is 2,200. Sale of inventory. So the sale of inventory, we are going to look at the double entry once again. So what happens? We record the receivables at the debit side at the gross amount. So let's go. We have 3,300 being the gross amount because that is the net plus VAT. So the gross amount is 3,300. And we record revenue at the credit side at the net amount. So the net amount is 3,000. And we record what? VAT. In the VAT control account. Which is 300. So actually this is how the VAT control account will look like. We credit the VAT on sales and we debit the VAT on purchases in the VAT control account. So we have 300, 200. The difference becomes what? 100. So the difference, which is 100, let's read something about it. It says the credit balance on the account represents an amount that is payable to the tax authority. So that is the net tax payable to January. So that is how we treat the VAT. So our next series we will be talking about fixed asset and depreciation. Thank you.